Hello and welcome everybody. This is David Silver, CEO of Instrumental Wealth, and Matt Harbert, Chief Investment Officer for Instrumental Wealth. And we've had a busy first quarter here and a lot of great questions clients have sent in as it relates to what's going on in the economy, the stock market, and certainly, Matt, a lot of things went on in first quarter. Maybe give us a quick overview of all of the things that took place in Q1 of 2022.
Okay. Well, certainly the first quarter was an eventful one. We are finally seeing the end of the pandemic. At one point, the Omicron virus was having cases about 800,000 a day, which has now dropped to under 30,000. Estimates are that Americans, about 95% of Americans, have some sort of immunity, whether that has been achieved through vaccination or infection. So it does appear that the pandemic is in the rearview mirror for now. But as we have come out of the pandemic, we've run into some supply chain issues. And that has made it difficult for manufacturers to produce at the levels necessary to meet the rising demand. And this has led to some significant inflation. In fact, we've just got the CPI, which came in at about 8.5%, which is the highest it's been in 40 years. It's also affected producers' costs, as a producer price index came in over 11%. So that is one of the highest we've reached in 40 years.
Yeah, and I know a lot of clients ask me, as well as our other advisors, a lot about inflation and what do we think is going to go on with inflation here over the next, call it 12 to 18 months? And do we think it's going to persist or calm down?
Mm-hmm. Well, I think some portion of inflation, we will see a peak and have it come back to more normalized areas. For example, energy. Energy is one that's been a significant contributor to inflation over the past year. However, these record high prices have also produced record high profits for businesses, and we expect that will bring people in and bring supplies higher than they've been. And vehicles. Vehicles have been another big contributor to inflation over the last year. Primarily driven by the inability for producers to get their hands on the chips that they need to manufacture vehicles. We do think that's going to come back down. In fact, this last CPI report, that was one of the bright spots, was that in new vehicles, prices have leveled out, and used vehicles, we've seen a pretty significant drop over the last month of just under 4%.
Right.
And that's been a trend over the last few months of used vehicle prices dropping. So potentially we're seeing a peak in that already. However, there are other areas that primarily have been impacted by the tight labor supply. And we've seen it in many of the service sectors and as well as the housing market. And they're being impacted by an extremely tight labor market. We've seen job openings,
right,
and quits are at record high levels. And unemployment is at also a record low level. Came in at about 3.5%, which is
it's the lowest we've seen in quite some time.
That's right. It's, in fact, there's only been one period that has been lower since 1970, and that was just prior to the pandemic. So we do expect those will probably remain more persistent, more sticky. So overall, I think we feel that there will be probably inflation will peak by the end of the year, and sometime by the end of 2023 might come down to about 3 or 3.5%, probably not back down to the 2% levels we've seen
over the last decade or so.
That's right.
Yeah. So certainly concerns, but looks like there are some potential bright spots with used car sales prices coming down. So one of the things that the Fed is mandated with is having more stability in pricing and how they have reacted, to the current high rate of inflation. So maybe you could speak a little bit about what's going on with the Fed and some of what their actions have been there.
Sure. Well, the Fed has taken on a much more hawkish stance. They did increase interest rates in the last meeting in March by 25 basis points. They also completed quantitative easing, and they have outlined a fairly aggressive strategy to reduce the size of their balance sheet. And that has resulted in an increase in interest rates. So we've seen the 10-year rate increase by about 140 basis points since the end of 21. On top of that, we did see a brief inversion of the yield curve. Didn't last very long, but it did invert.
Yeah. And again, around the interest rates, particularly around the inverted yield curve, Matt, I hear from clients as well as even just watching CNBC at night that an inverted yield curve is an indicator of recession. Maybe speak a little bit about the inverted yild curve.
Sure.
And what that means.
Sure. Well, historically, an inverted yield curve is considered a indicator of a recession coming up. However, keep in mind that typically will predict a recession about 18 months in the future. And while most recessions have been prefaced by an inverted yield curve, there's been many yield curves that have been inverted that have not led to a recession. Now, when we look at the economy currently, we do see that companies still have very strong profits. And with inflation rising and cost to businesses rising, they've still been able to pass those costs on to the consumer. So they've done a very good job of protecting their profit margins. So they're still in very good shape.
Mm-hmm.
And as of now, the consumer has not really changed their spending habits due to the higher costs. So while the risk of recession is increasing, I think the probability is higher that we'll see more of a slowdown to the economy and less of an outright recession.
Got it. Super helpful, thank you. So obviously a lot going on in Eastern Europe right now between Russia and Ukraine, and how does that war really affect our outlook on the economy?
Mm-hmm. Well, nobody knows how the result of the war will be.
Right.
However, we do know it's probably going to continue for quite some time. And what we do know is it's had a pretty unprecedented global response with governments around the world having significant economic sanctions. On top of that, we've had individuals and businesses all over the world that have refused to do business with Russia. And the impact of this has really been to constrict supplies further, particularly in oil, natural gas, and agriculture. So really what is likely to happen is this will continue to keep prices in those areas elevated and extend the time that we expect some of those to come back down to more normal levels.
Got it. So I think one of the questions that I get asked is, what are we doing in client portfolios in response to these items, right? We've got higher inflation, Fed raising interest rates, what's going on in Eastern Europe between Russia and Ukraine. Maybe, Matt, speak to a little bit about what we've done in client portfolios to help mitigate some of these risks or respond to what's going on.
Mm-hmm. So primarily what we've done is there are a few areas that we have some concerns, and we've tried to take some of those risks off the table and hedge. One of those, as we've just discussed, is inflation. And one of the biggest hedges for inflation is equities.
Right.
And we have an overweight to equities in our portfolio. So we do believe we have a somewhat natural hedge for inflation based on that overweight. Some other things that we've done as well is we put an overweight to emerging markets. And emerging markets typically have a pretty high correlation with commodities, and with commodities prices likely to rise, we think we'll have some opportunities there. On top of that, we've added some energy and some gold into our real asset bucket. And that's really to add a little bit of hedging to the conflict going on in Ukraine. Certainly, energy prices are already elevated, so it's not really there as a valuation piece. It's really there if more sanctions come or if Russia retaliates, we could see some significant increase in prices. And so we wanted to have some hedge with that as well. Interest rates increasing is another area we've had some concern. And so we also like our underweight to fixed income there as well. Obviously, increase in interest rates will negatively impact fixed income. So our underweight there should hedge that a little bit. On top of that, we've lowered our duration. So we have a much lower duration right now versus the benchmark. So it'll be much less sensitive to interest rates.
To rising rates.
That's right.
Got it. Wonderful. Well, thank you for that. And thank you all for submitting some of your questions. I know we get asked often these questions on a daily basis. And so we hope that this Q1 2022 market commentary was helpful. Certainly, if you have additional questions for Matt or myself or any of our advisors, please don't hesitate to reach out to us. And thank you all and have a wonderful day.